I'm Becky Quick of CNBC and your host of The Forum. I'll be guiding you through exclusive conversations among some of the world's global leaders. Conversations previously held behind club doors, but today we invite you in. The Economic Club of New York serves as the premier forum for nonpartisan discussion dedicated to connecting the world's brightest minds with preeminent public and private sector leaders. A nonprofit 501c3, the club is a 115-year-old platform for the conversations that help shape the future of our world. The Economic Club of New York, brightest minds, critical conversations, catalyst for innovation.
That was a crazy time, October 21st, 2019. You were appointed CEO at a time where Wells Fargo was in trouble. It was a mess. Fake account scandal, regulatory issues. I mean, what was it like for you? Why'd you take the job?
So for me, listen, obviously, we all knew the company over many, many years and saw the success that the company had. And it was, I just looked at it and thought and at the time was and should be one of the great financial institutions in the country. We'd lost our way a little bit. We had, made these mistakes in terms of our business practices, didn't respond necessarily the way we should. And so, the idea of taking something which, was once the most respected financial institution in the world, and to try and take what was still an amazing franchise and give ourselves the opportunity to be that again, those opportunities don't happen very often.
So you were at Bank of New York Mellon.
I was, and it was hard to leave. I mean,
Yeah.
I was at Visa for 4 years as CEO, came back to the East Coast for personal reasons, wound up running BNY Mellon, thinking I was going to be there for the rest of my career. I mean, there was no plan to do anything else. I knew someone on the Wells Fargo board. They called and I just said, listen, I'm not going back to California. I need to be on the East Coast and I've committed to being here. And then he called back, months later and said, you really should think about it. It doesn't have to be on the West Coast. A lot of the companies on the East Coast now, great opportunity. Thought long and hard about it, and the hardest decision was leaving something where I'd only joined a year and a half earlier. The idea of going to Wells was the easy part.
So you did it, you made the decision, and what was that like when you came in? Did you realize the scope of the issue?
Yes and no. I mean, I read everything that was publicly available, and I've been around long enough to know that, when there's an issue, there's generally much more than meets the eye. So the scope of the issues that we had to deal with were not surprising. What was surprising to me was the lack of progress that we had made, because until you get inside the company, you don't really know how far along the remediation is and how focused people are on it. And I got inside the company and it didn't feel like we were on a path to success. And this stuff isn't the most complicated thing in the world. I mean, it's just hard work. And so, getting people focused on what was really the most important thing we had to do, getting the right people in place to do it was the biggest priority, and that's what we focused on.
So did you know it would take, almost 6 years?
No. I mean, I would have, again, you don't know what you don't know. And so if you were just to go read the orders that we had in place and say, here's what's required, if you would assume that we had been working on these things for a bunch of years, you would have hoped that it would be another year or two until we could get some of these things closed. But unfortunately, we hadn't made the progress that we should have made along the way. And so for much of the work, we were starting from scratch. And so, anyone who's been inside these regulated businesses knows it takes 3 to 5 years to close a consent order. And given just a combination of the high profile nature of ours and possibly the politics of the country, it took a little longer than that.
I mean, possibly. What was it like dealing with the regulators? You were the punching bag.
Yeah, but to be fair, and I talk about this all the time, they weren't wrong. They were not wrong about the problems at the company. They were not wrong about the fact that we didn't do what we said we were going to do. We can argue whether the punishment fit the crime, and there you can have a difference of opinion.
Did it?
No, I don't think it did. I think
you mean the Fed asset cap?
I think the idea of an asset cap, it was novel at the time. It was viewed as something that had to be significant, and I don't think everyone understood exactly what the implications were. I think they thought the cap would be lifted faster than it was, and ultimately, I think what it did is it put one of the most important financial institutions in the world, let alone the country, in a place where we couldn't do the things that we were meant to do. We were limited on loans we could make. We're limited on deposits. And remember, I joined in October of 19, as you said. COVID hits in March. And so all of a sudden you have all these drawdowns on your revolvers, and also all of a sudden your balance sheet goes way up. Well, we had a hard cap, and there was like no remediation. You had to stay below it. So that meant that we stopped lending to other people, which in that time was not the thing to do. Then markets opened up, and so revolvers got paid down, but then the Fed started flooding the economy with cash. So people start bringing us deposits, and deposits come with cash, which then you bump up against the asset cap. So literally you got to tell people, please take your deposits elsewhere.
Did you tell Fed Chair Powell this?
Everyone inside the regulators understood what ultimately wound up happening. And I'm not sure they would do it again. I mean, I don't want to speak for them. I think, it wasn't something that had been done for a company of this size, and I don't think they understood what all the potential impacts could be under different economic environments. And, there are probably other ways to get the company to do what it needed to get done.
Senator Warren thinks you should still have an asset cap. Do you engage with her?
Listen, I would say, first of all, I try to engage with everyone in government, whether it's members of the administration, regardless of whether it's right or left, regulators and politicians that are elected on both sides of the aisle. I spend a lot of time in Washington. I'm probably in Washington 2 or 3 times a month. And most people are very open and receptive to conversations.
So how did you eventually get the cap lifted?
Listen, if you read the order, it was really very straightforward. There were 3 pieces to it. Our board had to be more effective, and there was a little bit of description of what that meant. We had to build a compliance program, and we had to build an operational risk program. And to have the asset cap lifted, it had to be adopted and implemented. And those are things that were pretty clear on what had to get done. So you just have to create the policies, you gotta implement it, you gotta make sure that people are following these things consistently across the company. But every one of the orders we had, including that one, had thousands of deliverables over multiple years. So once we started to do the work, we knew exactly whether we were making progress or not making progress, whether we were on track or not. And the most difficult thing for me running the company was communicating both internally and externally. Because the information about, and any information that has to do with our regulatory correspondence is all confidential. It's called CSI, confidential supervisory information. And it's a felony to disclose it. So you
didn't want to do that.
Didn't want to do that.
Yeah.
So it's really hard to talk to people about the fact that you believe you're making progress without being able to show all the things that we saw. And so that was one of the reasons why we were joking around before about how I hadn't done a lot of press.
Yeah.
Because I get in front of the press, we'd be in an interview, and the most important thing you'd want to ask about is the asset cap.
Your poor CFO, I asked every quarter.
I know, every quarter, and the same answers, we can't talk about it. But I tried to, by choosing my words very carefully, give some indication about how we felt about our progress. Meaning, when I first got to the company, I said, we understand what has to get done, and we're confident we can build the plans and get the work done. Then it was, I'm confident we're making progress. Then it's, I'm confident that we're going to get it closed. And so you just try and move forward with as much transparency as you can, knowing that it's not enough, but at least it's something. It was also really important that we didn't speak for the regulators. It's one thing for us to say we believe we're making progress. It's another thing for the regulator to say it's done to their satisfaction. And there's a lot of judgment that goes into that. And so I wasn't going to speak for them.
Would you like to be a part of the conversations at the Economic Club of New York? Learn more about membership, the New York City and National Fellows programs, and other opportunities for engagement in the club at www.econclubny.org.
You also, though, had to shift the culture of a bank, a very old and very large bank. Mm-hmm. How do you do that?
Well, it's interesting because there are great parts of the Wells Fargo culture, and then there were other things that needed a recalibration. And one of the hard things, one of the interesting things is figuring out, while you're trying to create a bunch of change, how you keep the good part as well. So everyone asks about all the things you need to change, but there are parts of the culture of the company that take decades and decades to build. And so, the idea of making people understand the importance of the regulatory work, the importance of us meeting our commitments, getting clear and focused about how we had to operate to get that work done. My experience is that if you explain to people what we have to do and why, which is very different than just standing up and barking orders. Like making it clear to people, not just what we're doing, but why we're doing it, you win their hearts and minds. And so that over time starts to change the nature of how you operate as a company and how we want to work together. And so, that we did put out a bunch of traits that we thought were important for senior leaders of the company. One of them was candor, which sounds like a weird thing that you got to tell a company that you actually want candor. But that's part of the issue about the culture of the company in terms of why we got into the problems that we did, because we had issues, we had problems, and we just didn't have the kinds of conversations that if it were your own company, you would want to have with your senior leaders. And so just things like that, setting those expectations, and then most importantly, just you and your management team living it every single day, incredibly important. It's, don't do what I say, do what I do. And so that's what we did. At the same time, we look at the fact that you want to talk to people about what you respect inside the company. I've seen this multiple times when I've gone to different places, or you see people get different jobs. The first thing they do is they spend all their time talking about all the things that have to change, all the mistakes that were made in the past, and how they're there to fix it. And even if there's truth in that, you got to remember that you weren't there sitting in the seat at the same time. You don't understand the circumstances that people before you went through. And so, there's a way to be clear with people about how to go forward without being critical about why we're in the situation that we're in. Instead, being very factual about what has to evolve and change. But then at the same time, making clear that you understand the great things about Wells. One of the great things about Wells is, it's not a me place. It really isn't. It's true across the entire business where people want to do the right thing for our clients. They want to work together. They don't walk around and talk about compensation. They believe that if they do the right thing for the customer, it results in good results for the company. We'll treat people fairly. And so this concept of getting people to work together is something that, this teamwork concept was just deeply embedded inside the place.
So you also cut costs along the way.
A lot.
So how different is the bank today than when you came in, October 21st?
Yeah, well, it's hugely different. When I think our peak was 277,000 people, like a quarter after I got there. And I don't remember this, I think we have 213,000 today. We've cut on a gross basis over $12 billion of expenses. Our net expenses are down $3 billion. So we've reinvested a lot of that savings into technology, into building products, into hiring people in businesses that we want to expand. And we're spending, I said this a couple of years ago, we were spending in probably $2 billion more per year to get the regulatory work done. So, the company has changed dramatically, and I would remind people that that's not because we've sold businesses with lots of people or outsourced things. Those are just the company becoming much, much more efficient in the businesses that we're in. And so it feels really different in that case, but we still have a long ways to go. I think it's just one of the great, I think about, like we always talk about peeling the onion back. You see the outside onion, it looks really obvious what has to get done. You peel it back, then you see the next thing. And so I think we feel really great about the progress that we've made. You feel it inside the company relative to how we do what we do it. But I think we also feel great about the opportunities, both in terms of just how we run the place, but also in terms of just the business opportunities.
I was going to say, so now you're sort of locked and loaded. You're more efficient. You're unshackled from the asset cap. What kind of growth do you see ahead of you?
We've made progress. It's both growth and returns. We talk about both of those things. To be a really great company, you want to strive for high returns, and in our business, we look at return on tangible common equity. But you also want to be growing, because you can have very strong returns for a period of time by not investing in the future, and you're just kidding yourself as to what that future looks like. So the return on tangible common equity it was about 8%. We had set a target for 15% as an initial destination. We're basically there. We're between 14 and 15 depending on the quarter. We were a little bit above 15 this quarter. But importantly in that, we have businesses that are growing. We're growing our card business, we're growing our corporate investment bank, we're growing our commercial banking franchise. And now, without the asset cap, we're able to focus on, I describe it as growing more evenly across the company. The parts of the company that are much more dependent on the balance sheet were constrained. And now all of those businesses can be more aggressive about both growing, but also growing with the intention of getting to higher growth with some of the highest returns with the people we compete
Why?
with.
What does Wells Fargo do better than all the other banks?
Well, I think the way we think about it is, first of all, we have a very unique platform. And I think, listen, we compete with great companies, big and small, local, national, international. All of that's the case. But when you look at the depth and breadth of what we have in what we can do for businesses and consumers, that's a handful of us that actually have these competitive advantages. And so, if you're a really small financial institution, whether you're a bank or a non-bank, those are tough to compete with. But they also don't have the scale, they don't have the customer base and have the reach that we have as a company. If you're a mid-sized company, that's kind of a tough place to be because you don't have the scale that we have, and scale is very, very real. It's real in almost all businesses, but we spend, call it $10 billion a year round numbers on technology. It's more important today than ever, and we can leverage that over 4,000 branches, not 2,000, 1,000, or 100. The things that we do to build out the client-facing businesses we have in our commercial bank, we use to leverage in our corporate bank. The things we do in our corporate bank help us build an investment bank. And so because we have these businesses that fit together, the most important thing is we can do more for our customers and our clients than most of the people we compete with. And so the question is just how effective are we at doing that and not letting our size or our historical issues get in our way.
Right, you have to build a culture of risk-taking without too much risk, I guess?
Well, I think you got to build a culture of, with all the right controls in place, you want people to feel that they can move quickly. You want people to feel entrepreneurial. You want people to be able to take risk, but within the risk tolerance that we have as a company, and not be afraid to fail on things, because you got to be willing to take that risk, because if you're too afraid to fail, you won't take it. But we as a company have to manage that in the context of the overall company, so if we're wrong, it's a mistake, it's not a big problem.
And what does the environment look like right now for that, the operating environment, the consumer environment, the business environment? It feels pretty good.
Yeah, it does feel pretty good. It's an interesting time because, to your point, it feels pretty good and it looks pretty good. So if we separate for a second what we know versus what we think, because those can be two very different things. What we know is we see strength almost across the board in all of our businesses. We have to work really hard to find weakness. So we look at our consumer businesses. Consumer spend is up in debit cards. Consumer spend is up in credit cards. And it's up like 5 or 6% year over year, every single week, week after week after week. Fuel prices go up, people spend a little bit less on everything else. Fuel prices go down, they spend more. And it's true of all the other categories that you see. There's this general level of growth and spend that you see. Consumers are spending, but they're not drawing down savings to do that. If you look at overall savings rates, deposit balances are increasing slightly, and they're not doing it at the expense of credit performance. Because as you look at that and go, well, are people not paying their credit cards and their mortgages? And our payment rates are higher, so delinquencies are coming down slightly, but are at really, really favorable levels. So that paints a picture of just almost kind of the perfect environment for the consumer. Now, it's not even across different affluence levels, but that's not a new phenomenon. When you look at it, consumers who have less are struggling more. It's not spreading anyway that we can see to higher affluence levels. And the strength in those that are more affluent are certainly bringing those averages up. But both groups are kind of relatively consistent in their performance. On the business side, businesses are strong. Businesses have, kind of came out of COVID.
Small and large?
Small and large, with very few exceptions. Any losses that we see are generally kind of very, very specific to the company, the circumstances, as opposed to kind of a broader credit problem that you see. So that's not the case. We don't see that. Large office properties in cities like New York and San Francisco and Chicago, if it's not an A building, it's suffering. And so, but even that has started to find a bottom. So you look at, all of the information and the businesses are performing well. Credit is strong, but the conversations we have would suggest that they all recognize their strength, but people aren't sure about what the future looks like, and so they're being very cautious.
You've been listening to The Forum by the Economic Club of New York, a nonprofit 501c3 dedicated to connecting the world's brightest minds for critical, nonpartisan conversations. Be sure to subscribe now to be alerted to future new episodes. Would you like to be a part of the conversation at the Economic Club of New York? Learn more about membership, the New York City and National Fellows programs, and other opportunities for engagement in the club at www.econclubny.org. I'm your host, Becky Quick. Thanks for listening.